Hey, dreamers. I keep getting questions about ETFs, even though I'm not an ETF investor. So I thought I'd answer the best way I know how by doing some research. Let me just say this: there are plenty of people out there waxing poetic about the ETFs they love. It might be good to spend a lot of time on those channels because this might be the only video I ever do on ETFs. But I do aim to please, so I'm here to round out my thoughts on this slice of the investing pie, and will show you which ones I own and which ones I will never own. So, here we go. Okay, so I put together this spreadsheet just to lay out the ETFs that I'm going to go over. And the first ones I want to go over are the Vanguard products. So it's VGT, VTI, VOO, VIG, and VNQ. So you can kind of see, starting with VGT, this one started back in 2004, so it's been around for a while. It's got an expense ratio that's okay at 0.1 and a yield that really is not very good at 0.65. It pays out quarterly and has a beta of 1.1, which is a little bit over of what I typically like to have. However, the 3-year total return is pretty nice at 29% and a 1-year return of 14%. Now, this market cap is large growth, and the investing style is passive, which means that it's kind of like set it and forget it. There's no person managing this account actively. But it does have a 5-star Morningstar rating. That's the highest you can get. And essentially, the description is, VGT is one of the most diverse ETFs available. And, not only does it include large cap, but also small and micro caps. Now, this is tech heavy, and it does include credit card firms, but it excludes telecoms. So Infidelity doing research, here we are at VGT. We can kind of see that the holdings are Apple, Microsoft, NVIDIA, Visa, MasterCard, Avgo, etc. So, like it said in the description, pretty tech heavy. And as you can see, the top two are Apple with 22% and Microsoft at 17%. So this always gets me because I think to myself, then why wouldn't I just hold Apple and Microsoft? See, this is one reason why I'm not an ETF investor. Because I always just start to think, why not hold, the ones that are in the account at the percentages that I want them to be at. But anyway, so this is the holdings inside of VGT. And this actually is an ETF that I do own. Okay, let's move on to VTI. So VTI started in 2012, so been around for about a decade. It's got a great expense ratio, 0.03. There's almost no cost to this one. Yield is okay at 1.23. It pays out quarterly. It has a beta of 1.04, and it has a pretty good 3-year total return at 17.4 and a 1-year total return of almost 12%. It's large blend, it's also passive, and the Morningstar rate is a 4. So VTI is another good broad ETF. Let's take a look at their holdings. So here's VTI, and you can see the holdings include, so not as much Apple, not as much Microsoft, and then it balances out with Amazon, Google, Tesla, NVIDIA, Berkshire Hathaway, etc., etc. So this one has a lot of the same ones as VGT, much more balanced approach to tech, but also is bringing in some other CPG, financials, and healthcare. Okay, let's move on to the next one, which is VOO. Started in 2010. It's got a great expense ratio, 0.03, an okay yield of 1.3, pays out quarterly, has a beta of 1, a 3-year total return of 18.19, a 1-year return of 16.39, so pretty good numbers there. Growth, and it's got It's a large blend market cap, so that means it's got growth and it's got value. It's also passive, and the Morningstar rating is a 5. So this one is just a nice, balanced, broad ETF. So taking a look inside VOO, this large blend, you can see once again, we've got Apple, Microsoft, Amazon, Google, Tesla, Berkshire, Facebook, United Health. See, this is another example where, I'm not a huge fan of Facebook. And when I buy an ETF, I am kind of forced to own things that I don't personally have the desire to hold. So, that always bothers me with ETFs. I would rather, create a blend of the ones that I do like, and I do like a lot of these, and keep the ones that I'm not as excited about out of my portfolio. But alas, that is VOO, and it basically tracks the S&P. So moving on to VIG, started way back in 2006, so it's been around for a while. It's got a very low expense ratio. Even though it's double the expense ratio of VTI and VOO, it's still extremely low. We've got an okay yield of 1.7, pays out quarterly, has a lower beta of 0.86, a 3-year total return of 15.2, 1-year total return of 15.5. It's also a large blend, so you're getting the growth and you're getting value. Passively managed, but this Morningstar rating is only a 3. Now, this is kind of interesting. To be in this fund, it's a little more curated, a little more selective. These companies have to have had at least 10 consecutive years of dividend growth to be in the fund. So that's kind of nice to have that. That's probably one of the reasons why that beta is a little bit lower, a little bit more steady. Now, this is one I don't own currently, but let's take a look at the holdings. So in VIG, the Vanguard Dividend Appreciation Fund, you can see we've got Microsoft, we've got United Health, J&J, PG, JP Morgan, Visa, Home Depot, Coke, Avgo, Costco. So then we go to VNQ, and this is the last of the Vanguard products that I have in here in terms of ETFs. So VNQ started in 2004. Expense ratio, the highest of the Vanguard products that I'm going over, 0.12, still extremely low. Yield is the highest, 2.15. It pays out quarterly. Beta is 0.9. The 3-year total return is 10.65. But look at this. This is a 1-year return of 20%. Now, this is one of the reasons why I picked up VNQ, because I really thought that last year and for the next few years that this one might be a nice one. So it's a medium blend. It's rated Morningstar 3, which over time that makes sense. But check this out. So VNQ actually tracks an index for the U.S. real estate market. It does stay away from specialized REITs, but goes in the direction of commercial REITs. So VNQ is one I like just because I'm pretty bullish on the real estate market for the next few years. So that is one that I actually do own. So that's the first section here in my mind, which is kind of like the 2% and under Vanguard products, super safe, super broad, and very low expense ratios. Okay, let's go on to the next section, which in my mind is kind of like the mid-range, mid-yield ETFs. So starting with SDY, it started in 2005, has an expense ratio of 0.35, a pretty okay yield of 2.4, pays out quarterly, beta of 0.9, a 3-year total return of 11, a 1-year return of 16, and it's a medium value play. It's passively managed and has a Morningstar rating of 4. Now, this is interesting because to be in this fund, you need to have 20 consecutive years of dividend growth. And let's take a look at the holdings. So here's the Spider S&P Dividend ETF. And you can see all holdings by weight, which at the top, you can see some oil funds. You've got IBM, there's AbbVie, PBCT, there's some REITs in here, Leggett and Platt, some utility companies, some financial. And so once again, I actually own a lot of these as individual stocks outside of an ETF. And some of these I am less interested in holding personally. But overall, I don't think this one is a bad ETF to own. Okay, so let's move on to SCHD. It started in 2011, has an expense ratio of 0.06, very nice. Pretty good yield of 2.61, quarterly payouts, beta of 0.9, and look at this, a 3-year total return of 18%. That is not too shabby. A 1-year return of almost 18% all by itself, also not too shabby. So this is large value, and I do think that large value stocks are going to do pretty well over the next few years here, especially if we just go sideways. So this one's passively managed, and this is actually a 5-star rating at Morningstar. And to be in this fund, these companies have to have at least 10 years of consecutive dividend growth. So that broadens the aperture a little bit, allows additional companies to come in, some of whom could be contenders and rising in the ranks. And actually, this is one that I do currently own. Let's take a look at what is in the holdings for the Schwab US Dividend Equity ETF. And you can see it here. So we've got Coke, Verizon, Amgen, Merck, Avgo, Pepsi, Cisco, Lockheed Martin, Texas Instruments, Home Depot, ADP, USB. So there's a few companies here that I actually don't own as individual stocks. And so it actually does help me broaden my portfolio. Okay, rounding out this section, we've got SPHD. SPHD started in 2012, has an expense ratio of 0.3. That's starting to cut into my profits. I've got a yield of 3.45, so okay, a little bit higher. Now this one pays monthly, which I always like because then it has more chance to compound. So it's got a beta of 0.97, a 3-year total return of 6.97. Now that is not the best, but a 1-year total return of 18.77. It's large value, it's passively managed, but only a 1-star rating in Morningstar. So you can see SPHD is a little bit different than the others. Basically, the description is SPHD cherry picks from the U.S. equity market rather than going after the entire basket. And one of the notes here is that SPHD tilts small and tends to be overweight in traditionally defensive industries like utilities and basic materials. The other thing is that this index is rebalanced only semi-annually, not monthly. So let's take a look at the holdings. So the Invesco S&P 500 High Dividend Low Volatility ETF is things like Williams Company, Altria, Kinder Morgan, AT&T, Philip Morris, Chevron, Verizon, PPL, Kraft Heinz, etc. And this is actually one that I own currently that I'm thinking maybe I should get out of. So of the 3 here, I actually really like SCHD. That to me is the best of these 3 in terms of low expense ratio, high total return. I like that it's large value. I like that it focuses on companies that have at least 10 consecutive years of dividends. So there's a lot I really like about SCHD. Okay, so now we're going to go into the final section of ETFs that I'll be covering. So starting with DIVO. Started in 2016, has an expense ratio of 0.55, which is much higher than what we've seen so far. But the yield is over 5%, which is great. And it pays monthly, which I think most people would prefer. We've got a pretty good beta of 0.8 and a pretty nice 3-year total return at 14.87. The 1-year return is also pretty good at 16.49, and it's large value, which, as you know, I like, especially for the next few years. Now, here's where it starts to get very different. How do you make money with DIVO? Part of the way you make money is through the dividend, but the other part that you make money is through derivative income and capital gains. So DIVO uses an actively managed income-focused strategy, and the fund aims to generate between 4 to 7% annual gross income from two sources. It's the ones that I just mentioned, the dividends plus the option premiums. So how this works is the fund manager selects about 20 to 25 dividend-paying stocks from various sectors in the S&P, and then tactically writes short-term call options on those stocks to generate additional income. And this buy-right strategy provides some downside protection, but also does forego some upside potential. And what that means is the upside stock price potential. So the other important note here is that when you do your taxes, it's going to be a mixed outcome. There's going to be some qualified dividends, some ordinary dividends, and then some long-term capital gains. That's just good for you to know. If you want to buy and hold DIVO, it might be best to hold it inside of a retirement account, just because you're going to have those ordinary dividends, which are taxed at your normal tax rate. So, guys, this is another reason why I like holding just the individual stocks, because when you hold the individual stocks, you have qualified dividends that are taxed at a lower rate. But in any case, back to DIVO. So Morningstar gives DIVO a 5, and let's take a look at the holdings. So here's DIVO. It's Amplify CWP Enhanced Dividend Income ETF. And you can see what's in here. We've got Chevron, United Health Group, Apple, McDonald's, Visa, Microsoft, Procter & Gamble, Nike, etc., etc. Now, the holdings in this group are important because you get some of the dividend income, but also a little bit less important because the way that it's making money is actually through the derivative income strategy. So in those kinds of ETFs, it matters more what the strategy is over what the holdings are. But I must say, I don't currently own DIVO, and I don't think this is a bad one. I think it's a very interesting one. Okay, let's move on to PFXF. This one started in 2012. It has an expense ratio of 0.4. It has a yield of 5%, and it pays monthly. The beta is 1.3, which is not so great. A 3-year total return, which is not so great, at 3.6. A 1-year return of negative 1.5, which is obviously not great. And this one is preferred stock ETF. It's passively managed, and it gets a 4 on the Morningstar rating. So this one is just dividends, no derivative. So let's take a look at some of the holdings. Okay, so PFXF, which is VanEck Preferred Securities Financials. And you can see there's Avgo, Nextra Energy, Southern Company, PG&E, and a bunch of different ones in here. And this is one that I do own currently. All right, let's go to PGX. This started in 2008. It has a 0.5 expense ratio, a 5.15 yield, pays monthly, a 1 beta, 7% 3-year return, 5.71 1-year return. It's a preferred stock basket again, medium size, passively managed, and it ranks a 3 on Morningstar. So this one includes both investment grade and high yield with an average credit rating of B3 and undergoes monthly rebalance. Inside of PGX, we have Citigroup, Wells Fargo, JP Morgan, Bank of America, AT&T, etc. Okay, let's move on to JEPI. So the first thing I notice is it started in 2020, which makes me a little bit nervous because there's not a huge history to go off of. We've got an expense ratio of 0.35, which is okay, a yield of 7.16, which is nice. It pays out monthly. It has a beta of zero point 0.8, and we don't know 3-year total return because it is too new. It has a 1-year total return of 16.9, which is nice. Market cap target is large blend, but this one is 100% derivative income. And it's actually not rated by Morningstar. And I think that's because it's just too new. So how does this one work? Because, if you go to Fidelity to see what's inside of JEPI, which is JP Morgan Equity Premium Income, it starts to look a little funky, right? So you see that this is what the holdings look like, which is a little confusing. But again, it really is all about the strategy that they're using to basically create the income. It's not really based on the quality of those businesses or the dividends that those businesses give off. So you really have to understand the strategy that they're using to create this income. So in this case, they are using equity linked notes in order to generate that income. And the little note here is interesting, which is the fund may also underperform in a rapidly rising US equity market due to the call options written. So this is where I start to get nervous. As you know, I'm living the dividend dream, and this is just not a dividend. I would really want to know exactly what they are doing day in and day out with these equity linked notes. It just makes me nervous when I see something like this. And this is not one that I currently own. The next one is NUSI. And NUSI started in 2019, so it's another one that's pretty new. It's got an expense ratio of 0.68. See, this is where, even though 0.68 seems like a low number, over time, it really starts to cut into your net worth. And I just generally stay away from anything with this high of an expense ratio. It's got a yield of 7.79, monthly frequency payout, 0.7 beta, and too new to have a 3-year total return, and a 1-year total return of negative 2.91. Not great. This one is large growth. Options trading is the investment style, and once again, it's not rated by Morningstar. So what is NUSI's strategy? Well, they use something called a collar strategy. A collar strategy involves selling or writing call options and buying put options, thus generating income to hedge some downside. So once again, they're not giving you dividends. And all of this is going to be taxed completely differently than the tax advantage dividends. And this is also one that I do not own currently. So let's continue. PFFA started in 2018, has an expense ratio of 1.21, which, as you know, is way beyond what I would accept. We've got an 8.2 yield, monthly frequency, and a super high 2.42 beta. Wow, that is just way beyond my threshold of about 1. So we've got a 3-year total return of 8% and a 1-year total return of 14%. PFFA uses preferred stock, but here's the kicker. It is leveraged derivative income, which essentially means they're borrowing money. So this one's a Morningstar rating of 1, and no, I do not own it. This one scares me. So let's move on to our RYLD. Started in 2019, still new. Expense ratio of 0.6, a yield of 11.7, monthly payouts 0.9 beta, 1-year total return of 11.95. Now this one is small blend. We're looking at the Russell 2000. And once again, they're writing a succession of 1 month at the money covered call options. So this is another derivative income. They're not paying you dividends. Once again, I mean, in my mind, it's not even worth seeing what the holdings are, because it really isn't about the holdings. It's about the strategy that this manager uses in order to write certain covered call options. Okay, so let's finish this out. So the next one is QYLD. Started in 2013, expense ratio of 0.6, a yield of 11.9, monthly payout 0.7, beta, 3-year total return of 8.36, a 1-year total return of 1.91, large growth, derivative income, and Morningstar rated 4. So this one is based on the NASDAQ, and they write or sell a succession of 1 month at the money NASDAQ 100 index covered call options. So what's interesting about this one is it's basically all based on QQQ. The thing that kind of bothers me about this one is that, you don't own the stock, so you're not getting any of the stock upside on large growth. And if you look at the income over time of QYLD, the income is relatively flat. So you're really not growing over time. All right. And the last one here is XYLD. Started in 2013, 0.6 expense ratio, 12.15 yield, pays out monthly, a beta of 0.75, 3-year total return of 9.4, 14.63 1-year return. It's large blend. Again, they make money based on the derivative income. Morningstar gives it a 3. And in this one, they're writing calls against the S&P 500 in order to earn the premium. These calls are 1 month at the money call options on the index. But again, some of the problem with this is it does create a drag on the upside potential, so you're not getting stock appreciation. And also, just as a reminder, the income you get is not a dividend. So with all this said and all this research, what do I think for myself? Would I buy these? Would I hold these? What do I like? Well, I like BGT. I like BTI and VU. I somewhat like VIG. I like VNQ, SDY, and SCHD. And I somewhat like SPHD. What I really like here is a SCHD out of all of these. And this is something that I might start to move towards in terms of my ETF positions. And then moving down into kind of the second section here, I was really surprised at DIVO. I actually like a lot of what I see there. I like that it's a little bit of a blend. You get the dividend, you get some derivative income, but it seems much more curated and targeted. I like the total returns that I'm seeing. I like the yield that I'm seeing. Expense ratio, of course, I don't like, but DIVO really surprised me, and this could be something that I buy and hold in the future. Going into the preferred, I do currently hold PFXF and PGX, but I might actually take these down or sell. This was surprising to me as I did the analysis, that it wasn't really performing certainly as well as DIVO. So that's something to keep in mind. And then going into what I guess I would call the more advanced ETFs, JEPI, NUSI, PFFA, RYLD, QYLD, the YLDs. Well, I really don't like JEPI, I don't like NUSI, and I really, really don't like PFFA. And the reason there is, I kind of have this note on my whiteboard that says, never, ever, ever buy a leveraged ETF. So that's pretty much the reason why I'm not a huge fan of PFFA. And I'm just not a huge fan of the YLDs. Well, I hope you found that helpful and insightful. Thanks for watching. As always, I encourage you to do your own research and keep learning. And the disclaimer, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.